Many people believe that building wealth through investing requires complex strategies, constant market monitoring, and a high tolerance for risk. However, the truth is that some of the most successful investors have followed a much simpler and more consistent approach. The key isn't to outsmart a market every day, but to develop a strategy that works over time and stick to it with discipline. This video will guide you through a straightforward investing strategy that has proven to build wealth steadily and reliably, even for beginners. Whether you're just starting your financial journey or looking to simplify your current approach, this method can serve as the foundation for long-term success. Let's start with the core principle: consistency beats intensity. That means you don't need to invest huge amounts of money all at once to build wealth. Instead, regular investing, even in small amounts, can have a massive impact over time thanks to the power of compound interest. This strategy is known as dollar cost averaging. It involves investing a fixed amount of money into your chosen investments at regular intervals, regardless of whether the market is up or down. Over time, this evens out the purchase price of your investments and reduces the emotional pressure of trying to time the market. For example, if you invest $100 every month into a low-cost index fund, you might buy more shares when the market dips and fewer when it rises. This approach naturally avoids the common mistake of buying high and selling low, which many emotional investors fall into. It also helps build a habit, turning investing into a regular part of your monthly routine, like paying rent or saving for groceries. And perhaps most importantly, it keeps you invested, which is crucial, because time in the market is far more powerful than timing the market. Now, let's talk about what you should invest in. You don't need to become an expert in stocks or read financial news every day to be a successful investor. In fact, most beginners benefit from keeping things simple with diversified investments like index funds or ETFs. These funds track a large group of companies, such as the S&P 500, and offer instant diversification at a very low cost. Instead of guessing which stock will do best, you're investing in the long-term growth of the entire market. This reduces risk while still providing strong returns over time. Another important part of this simple strategy is automation. By setting up automatic transfers from your checking account to your investment account, you remove the temptation to skip a month or wait for the perfect time to invest. Automation not only ensures consistency, but it also takes the emotion out of investing, which is often where people go wrong. When markets drop, many investors panic and sell. But with an automated, long-term plan, you can stay the course and even benefit from those market dips by buying at lower prices. Let's not forget about the importance of setting clear, realistic goals. Ask yourself, what are you investing for? Is it retirement, a home, your children's education, or simply financial freedom? Defining your goals helps you choose the right investment strategy and stay motivated. And tracking your progress along the way keeps you accountable and focused. As your life changes, your investment strategy can evolve too, but the core principles should remain the same. Stay consistent, avoid emotional decisions, keep costs low, and give your investments time to grow. Even if you can only invest a small amount now, starting today will make a bigger difference than waiting for the right moment. To put this into perspective, consider this: if you invest $200 per month in a low-cost index fund with an average annual return of 8%, after 30 years you'll have over $280,000. That's the power of compound growth: small, regular contributions building massive wealth over time. And the sooner you start, the more time your money has to work for you. It's also essential to avoid common mistakes. Chasing hot stocks, reacting to short-term news, or trying to beat the market rarely works out in the long run. Stick with your plan, and remember that short-term volatility is normal. What matters most is your long-term behavior and discipline. Also, keep your costs low. High fees can eat into your returns more than you might think. That's why low-cost index funds and ETFs are so effective. They allow more of your money to stay invested and grow. Over time, even a 1% difference in fees can cost you tens of thousands of dollars. Finally, stay educated and stay patient. You don't need to be a financial expert, but understanding the basics of investing, compound interest, and portfolio diversification will help you make informed decisions. And remember, investing is not a get-rich-quick scheme. It's a long-term commitment to your future self. By following this simple, time-tested investing strategy: investing regularly, staying diversified, keeping costs low, automating your contributions, and staying the course, you give yourself the best possible chance at building lasting wealth. So take that first step today. Start small if you have to, but start. Because the sooner you begin, the sooner you benefit from the magic of compounding. Your future self will thank you. If this video helped clarify your investing path, don't forget to like, subscribe, and turn on notifications for more beginner-friendly financial content. Remember, simple strategies lead to powerful results when applied consistently over time.